You open your banking app, the number looks the same, 5 figures, clean, intact, quiet. So you tell yourself you're being responsible. Safe, discipline. That's the illusion. From 2021 through 2025, consumer prices in America rose hard enough that cash lost roughly 24.5% of its purchasing power. Your money looks still on the screen. In real life, it was evaporating. Do the math. $10,000 sitting there at the end of 2020 needs to become about $12,452 just to buy the same life. Same groceries, same gas, same insurance, same suburban existence, mortgage, car payment, HOA fees, quiet pressure. See, this is how wealth destruction works. Not with a dramatic collapse, not with one catastrophic mistake, with a perfect looking number that hides a shrinking future. Your cash is not protecting you. It is giving you the feeling of safety while your optionality bleeds out in silence. And that is only the first layer of the damage. So what exactly is your safe money costing you? Investing was never about looking smart. That's the story you were sold. Pick the right stock, time the market, beat everyone else. That story is wrong. Investing is not a performance, it's a system. A system that converts your labor into assets that can outrun time. Because time is not neutral. Time compounds for you or it compounds against you. See, for most people, hesitation isn't stupidity. It's wiring. Your brain is running outdated survival code. Status quo bias. Your mind prefers what's familiar even when it's slowly weakening you. Keeping cash feels safe because it doesn't move. But stillness is where the damage hides. Loss aversion. You feel more pain seeing your portfolio drop than losing purchasing power invisibly. So you avoid visible loss and accept invisible loss. Present bias. Your brain prefers relief today over freedom 10 years from now. So you delay. You wait. You say you'll figure it out later. But later is where compounding either builds your life or abandons you. Plot twist. You were never losing because you didn't know enough. You were losing because you were trained to fear the wrong thing. You were taught to fear volatility, not stagnation. You were taught to fear red numbers, not evaporating purchasing power. Your financial operating system is optimized for survival, not wealth. And until that changes, you will keep choosing what feels safe over what actually builds optionality. So the real question isn't where to invest. It's this. What is standing still really costing you? Let's strip this down. Doing nothing is not neutral. It's a decision, a measurable one. From 2021 to 2025, prices didn't just rise. They compounded 7%, 6.5%, 3.4%, 2.9%, 2.7%. Stacked, relentless. Now watch this. $10,000 becomes $12,452 just to stay still. That missing $2,452, that's not bad luck. That's wealth destruction. And here's the danger. You didn't feel it. No alert, no panic, no warning. Just a slow erosion of your future lifestyle. Your brain sees stability and labels it safety. That's the trap. You think you didn't lose anything. The math says otherwise. The math doesn't lie. You weren't holding value. You were holding decay. Like watching a high-resolution movie slowly lose clarity frame by frame. You don't notice it immediately. But 10 minutes later, everything is worse. That's your purchasing power. That's your life. And you felt responsible the entire time. So be precise. Standing still didn't cost you a little. It cost you over 24% of your future. And that's before we even talk about time. Because inflation isn't the real loss. Time is the only asset that multiplies everything else. And once it's gone, it's gone. This is where your brain fails you again. Scarcity mindset. When money feels tight, your brain locks into survival mode, not strategy. Layman translation, your attention gets hijacked by this month's bills and your future disappears from view. Then comes the tunneling effect. You zoom in on urgency, rent, car payment, credit cards, and you zoom out of what actually builds wealth. Your brain is zoomed so close, your future falls out of the frame. Now quantify that. $100 a month, not luxury, not excess, just 100 invested consistently for 30 years at 8%. That becomes roughly $149,000. Do the math. $100 turns into $149,000. So every time you say, it's small, it doesn't matter, what you're actually saying is, I'm willing to trade decades of compounding for short-term comfort. This is not about discipline. This is about awareness. You are not spending money. You are spending time. And that time could have multiplied that money. You don't lose that $149,000 at the end. You lose it quietly, month by month, decision by decision, delay by delay. That's how optionality disappears. Not in one mistake, but in 1,000 invisible ones. This is not a money problem. It's a time leak. And if you don't fix it, no strategy will save you. Because even if you invest, you can still sabotage everything. This is where the damage accelerates. Because once people start investing, they try to look smart, they chase winners, the next big stock, the next breakout. That instinct, overconfidence bias. Your brain overestimates its ability to predict outcomes. Layman translation, your ego wants a hero story. But money doesn't reward stories. It rewards probability. The market doesn't care how smart you feel. It only cares how consistent your system is. Plot twist, the people who win long term stopped trying to look clever. They stopped asking, what's the next winner? They started asking, how do I own the system? That's where index funds come in, not as a shortcut. As a structural advantage, index, a list, fund, pooled money. Together you own hundreds of businesses, not one bet, a system. Now the part most people ignore, cost. It looks small, it feels irrelevant, it isn't. The average index fund costs around 0.09%. Active funds around 0.56%. Sounds harmless. It's not. Run it over 30 years. $10,000, 8% return. Low cost, about $98,000. Higher cost, around $86,000. That's over $12,000. Evaporating. Not from bad investing, from friction. Invisible chains. Pulling your future down quietly. This isn't about picking the right stock. It's about removing what destroys compounding. And even then, there's still one force left. The one most people underestimate. Now, here's where it gets brutal. Even with the right system, you can still lose quietly. It starts small. A fraction of a percent. A manageable balance. A minor leak. Your brain ignores it. There's a reason. Inattention to slow bleeding. You react to big shocks. You ignore slow damage. Layman translation. If it doesn't hurt immediately, your brain pretends it's harmless. That extra fee, it compounds. That small inefficiency, it compounds. Until one day, you realize you didn't lose from one mistake. You lost from friction. That's not a fee. That's an invisible tax. And then comes the real destroyer. Debt. Credit card interest in America sits above 20%. Some accounts near 23%. That's not interest. That's a furnace. You invest hoping to earn 8%, but you're paying over 20%. Do the math. You are running uphill while something behind you pulls twice as hard. That is not investing. That is wealth destruction. Then comes the final trap. Self-soothing finance. You invest not because your system is ready, but because it makes you feel better. Meanwhile, interest compounds, fees bleed, structure collapses. You cannot out-invest a broken foundation. You cannot build wealth while something is setting it on fire. Before returns, you fix the leaks. Because until you do, every dollar is fighting invisible chains. Now, here's the rule. Not motivation, a system. A 60-second filter every time money hits your account. No emotion. Step 1, high interest debt, fix it. Nothing else matters. Step 2, do you have 3 months of real cash? Not credit, not hope. Cash. Step 3, only then invest. And only money you don't need for years. Step 4, automate everything. Consistency, low cost, broad exposure. You stop trying to win. You start trying not to lose. You stop chasing outcomes. You build a system that survives you. That's deliberate living. That's how you protect optionality. And when the system is intact, you leave it alone. Because the final mistake is panic. Fast forward. You're 70, same country, same system, 2 outcomes. In one, nothing dramatic went wrong. You stayed safe. You avoided risk. You avoided discomfort. And slowly, your future shrank. No collapse. Just quiet years of erosion. Now the margin is gone. Optionality? Gone. Not in one moment. In thousands of silent ones. In the other life, nothing flashy happened. No genius moves. Just a system. Leaks fixed early. Debt eliminated. Consistency. Time did the work. Now the pressure is gone. Decisions are lighter. Work is optional. That's optionality. 2 lives. Same income. Same starting point. One optimized for comfort, the other for freedom. The difference? Quiet decisions. Repeated long enough to matter. The market was never the main threat. Your need to feel safe was. Choose carefully. Most wealth is not lost in one mistake. It evaporates in quiet years.